Now, clearly there is a momentum of rebound in equity volumes and in equity listing. 23 was a dry year. 24 is going to be a pivoting year in this respect, and the two examples you have mentioned are really the first signals of a pipe which is much thicker. Clearly, uncertainties on equity valuations and volumes was there in 23, but many deals that were scheduled in 23 were postponed, and they are going to happen now because market conditions have recovered.
So specifically, what type of companies are in the pipeline? Because looking at the names that are floating around, Puig, Douglas, Golden Goose, they're all very consumer focused. Is there any tech in that pipeline?
Yes, there are techs. I mean, as a rule of, we prefer to let the companies communicate their plans for going public, and that's not up to me to do it. But what I can tell you is that you have three fundamentally different families of deals. You have carve-outs, which is really a new, and spin-offs, which is going to be a good contribution to this, the new pipeline for 24. You have consumer goods companies, branding companies, and you have mentioned a few of them. And you have the tech guys who are now getting mature all over Europe and ready to go public. And many tech deals were about to take place in 23 and are going to happen in 24. So I'm very confident about the pipeline of 24 when it comes to listing.
Any concern what could derail potentially that IPO momentum, the inflation picture, geopolitical uncertainties, anything worrying you?
You know, I think the driver of equity markets is clearly interest rates. That's what we have observed over the past 4 years, is that no matter geopolitical risk, no matter any other fundamental uncertainties, what has been the main driver of equity valuations and equity markets has been interest rates. In an environment where there seems to be a sort of plateau on interest rates and potentially prospects for declining interest rates, I think equity markets are going to be back big time. So, and hence listing. So I'm confident that the conditions will be there. Now, you can always think of a macro event that could dislocate those markets, but in reality, when you look at what happened since 2020 with COVID, slowdown in China, energy crisis, inflation, interest rates climbing, war in Ukraine, etc., markets have followed only one metric, which was interest rate.
But there were European companies going on the market, Arm, Birkenstock, but the thing is that they went to list in the US. And we know that the fragmentation in Europe has been an issue in terms of competitiveness against the US. So what's your view on that? Is that still the big headache here in Europe?
Well, I think the US problem is more a problem for London than a problem for Europe. In Europe, Euronext, has created a single liquidity pool, a single order book, a single rule book, which accommodates 6.7 trillion of aggregate market capitalizations. It's twice the size of the companies listed in London. Today, we trade between 9 every day, between 9 and 10 billion euro. It's more than twice the size of the volumes traded in London. So today, the largest liquidity pool for equity trading is within Euronext, and London is much smaller. Now, it's true that when you are considering international listing now, you look at London and Europe differently than 10 years ago or 5 years ago, because 5 years ago, London was the largest financial center of the European Union. Today, London is the largest financial center of the United Kingdom, with a global ambition, which is very dynamic and very successful in non-equity asset classes, in Forex, in corporate, in fixed income. But when it comes to equity, the reality is that the debate is Europe, Euronext, or the US. And that's a problem which is very present in London.
No, so certainly you are doing your bit in terms of European integration, but there is still a fragmentation there. And they say, there's just not enough to help European companies raise funds to bring particularly unicorns, for example, and bring all the financing because of the European capital market not being integrated enough. So the policymakers seem to agree on that. Christine Lagarde seems to agree on that. The bourse operators seem to agree on that, but it's not happening. So what's blocking this integration?
No, I think integration is going to happen more quickly than ever. We are going to have a new momentum with the new elections to the European Parliament on the 9th of June, a new European Commission in office in July. And integration is going to accelerate. We will have some form of single supervision of market infrastructures sooner or later within the next regulatory cycle of the new European environment. We will have, within the next few months, a European S1, a European single prospectus. That will be a game changer for equity capital market teams across the world. So there is an acceleration of integration which is happening. There will be a repivoting of European savings towards equity. The purpose of the new cycle at the European Union is how to activate European savings, which is the highest saving pool in the planet, towards financing European companies instead of financing public debt in the US. And that trend, that commitment is there within the European Union leaders that are preparing for the next cycle.